Hello, my name is Rick Gray. I'm a certified public accountant and founder and president of Global Tax Service, LLC. We're a public accounting firm specializing in preparing individual tax returns for U.S. taxpayers living and working overseas. We have clients working for international conglomerates, for non-governmental organizations, and entrepreneurs with their own businesses overseas. But our principal focus is providing tax advice and tax preparation services to American educators working and living overseas, whether they work in American, international, or local schools, or on branch campuses of U.S. colleges and universities located overseas. Today I'm going to talk something about retirement planning because the planning overseas is very different than when you're living in the United States. Before I begin, I want to point out that while the information we are providing is accurate, it may not apply to your specific situation. In that case, please provide us written comments or questions to our email address, which is info@globaltaxonline.net. When you move overseas, you may have already accumulated some money in 403(b) or 401(k) plans in the United States. You probably have worked with Social Security coverage for a number of years, earning credits toward ultimate qualification for Medicare and for Social Security retirement. When you go overseas, you're on your own for planning the rest of your retirement. Of most importance is to ensure that you have a minimum of 40 credits under the Social Security system for both Social Security and Medicare. Some educators in the United States work in states where the state does not pay into the Social Security retirement system, but only into the Medicare system. So be sure that you have at least 40 credits, both on the Social Security retirement side and on the Medicare side. If you've gone overseas short of that number of credits, there are several ways that you can earn those credits while continuing to live and work overseas. If you're an educator with a normal summer vacation, you may find employment in the United States for 1 or 2 months during the summer. And if you do so, every approximately $2,500 that you earn earns you 1 Social Security credit. Some teachers also tutor or are coaches, referees, and have other sources of income outside their school. In those cases, normally, unless you're in a country with a U.S. foreign country Social Security totalization agreement, you're required to file that as self-employment income and to pay self-employment tax on that income. Self-employment tax is the same as Social Security tax. So again, if you have $2,500 approximately from self-employment income while you're working overseas, you would earn 1 credit for both Social Security and Medicare. If you've taken care of the Social Security portion, you need to turn to other planning so that you'll have an income stream that's larger than just what you will get from Social Security. Many of you think that by contributing money to individual retirement accounts, you can meet that need. However, if you exclude your U.S. income from your foreign earned income from U.S. tax, and you earn less than the foreign earned income exclusion amount, approximately $100,000, you have 0 taxable earned income. The requirement for qualifying to contribute to any type of individual retirement account, whether traditional or Roth, is that you have taxable earned income. So you're able to contribute either $5,500 or $6,500 if you're over 50, or taxable earned income, whichever is less. If you've excluded your foreign earned income from U.S. tax, you have 0 taxable earned income, and your contribution limit to your individual retirement account is 0. If you weren't aware of this and have been contributing to an individual retirement account while living and working overseas, you need to take corrective action as early as possible, because there is a 6% penalty per year for each year that excess contributions remain in your individual retirement account. Cumulatively, that means if you've been overseas for 5 or 6 years, you owe 30% of the value of the contribution to your IRA for that first year overseas, and 24% on the next year's contribution, and so on. We've had clients who end up paying penalties that exceed the amount of money they had actually invested in the individual retirement accounts. To avoid this problem, you need to withdraw excess contributions as early as possible to minimize the penalty that's due. I met a couple one time in South America, both of whom were planning on retiring in the year that I met them. They'd been putting money, excess contributions, into individual retirement accounts for over 20 years. As it happens, the IRS elected that year's tax return to audit. And when they saw there was an excess contribution for that year, that opened up all of the years that they had made excess contributions to audit, meaning they weren't limited by the statute of limitations. The IRS went back 20 years. They had to withdraw the excess contributions. They ended up deferring their retirement. And about 5 years later, when I last saw them, they were still working because they hadn't recovered from the penalties they had to pay on their excess contributions. You may have worked in the United States in a place where you accumulated money in a 403B or 401k deferred compensation plan. Those plans are available in a few schools overseas. If you work in a school that offers a 401k or 403B, you do not have to have taxable earned income to contribute, and we recommend that you contribute as much as you can up to the maximum amount to those accounts. Most schools, however, do not have those types of plans, and in any case, everyone needs money besides the money they're putting aside for retirement. First of all, you should have short-term money. That means you need money in the bank to cover your living expenses for a period from 3 to 6 months. If you have children, you might want to look at having money in the bank to pay for 6 to 12 months. During the currency crisis in the Far East some years ago, schools in Indonesia found themselves without access to any form of cash. The teachers were laid off and had to make their own way back to the United States and were without regular employment for the balance of that school year. Those who didn't have short-term savings ended up living with their parents, substitute teaching, and generally found it very difficult to readjust until they were able to obtain employment the following school year. There are advantages to having that money accumulated in the United States in a 403B or 401k plan, particularly if it's pre-tax. One of the advantages you have is that you can roll that money free of tax into a Roth IRA while you're overseas. While you may not be able to contribute new money to individual retirement accounts, you can roll money from existing accounts. That means if you have pre-tax earnings in a 401k or a 403b plan or in a traditional IRA, you can roll that money from any of those accounts to a Roth account, meaning that while you will pay tax on the money you roll in, the earnings will be forever tax-free. When you file your U.S. tax return and you exclude your foreign earned income, you still have a standard deduction and personal exemption subtraction, meaning that normally you have about $10,000 of negative taxable income. What this means is that you could roll up to $10,000 a year from pre-tax plans to a Roth IRA, pay all the tax that's due at the zero rate, and end up having a tax-free retirement with that money that formerly would have been taxable at withdrawal. Aside from short-term money and rolling money into a Roth IRA from pre-tax accounts that may already exist, you need to accumulate midterm money. Midterm money is meant to fill two needs. One is housing. You may not own a home in the United States, and you may not want the hassle of owning a home in the United States while you're living overseas. We recommend that you invest money in a real estate investment trust or in a real estate mutual fund, and that becomes, in effect, your home. Continue contributing to that until you've accumulated the amount of money that will allow you to make a down payment on the home in the United States, or continue contributing and just pretend that is your home, and when you retire, you cash it out and buy the home where you want to retire. The second reason that you need midterm money might be that at some point you're going to want to take a year off to continue your education, to get a higher degree. You may want to buy a car. You may be looking at a point where you'll be paying tuition for your students in college, and all this requires midterm money. That means money that's available to you prior to retirement. You can invest in regular mutual funds or a market basket of stocks and bonds that will return income on your investment, and again, you'll owe zero tax. Because, as I mentioned earlier, if you're single, you have about $10,000 of negative taxable income that you can use, meaning with average rates of return of about 6%, you can accumulate up to $150,000, pay tax on the capital gains and dividends that you earn each year at the zero rate, meaning whenever you decide to use the money, it has all been tax paid except the portion of growth for the current year. You need to look at short-term, mid-term, rolling pre-tax money into Roth IRAs, completing your Social Security requirements, and having done that, you should be prepared for a retirement that will allow you to live in a style that you would like to be accustomed. If you have questions on any of this, please drop us a note at info@globaltaxonline.net. That's info at, all one word, globaltaxonline.net. Thank you.